Hey, how's it going, everyone? Mark Anderson here, construction worker turned zero DT hedge fund manager. Today, I wanted to go over a backtest and mainly the concept in regards to behind that backtest. So the first thing I kind of wanted to address here is this is basically an article, I'll link in the description for Party at Moon Tower, where Chris here talks about how when we have an edge, if we're able to create more occurrences of that more often, so as long as our backtest or our price is accurate on it, that edge gets drastically compounded over a period of time. So you can basically see here that as we go on with additional trials, our probability of losing goes drastically down. Even if our Sharpe is relatively small in one occurrence, if we can make that occurrence every single day or multiple times a day, the benefit to it and therefore the aggregate result is much more. So you see here that right here, you've got a 50.5% chance of winning and a 49.5% chance of losing, or basically an expected value of 1% per trial. So you can see after one trial, your Sharpe is 0.2. But as we go down, let's say to 64 trials, our Sharpe is 0.16. As we go to 1,000 trials, our Sharpe is 0.64. And as we go to 4,000, our Sharpe is 1.28. And our probability of losing money goes drastically down. So this is something I want to try to mathematically and quantitatively define for the benefits of backtesting as opposed to kind of curve fitting some type of entry that may only trade every Friday if the VIX goes up and down. So I want to make money based on math. This is math. Small Sharpe multiplied over many occurrences equals bigger Sharpe. This is even more compounded with additional trades in the portfolio. The next thing I'd like to cover when we're going through a backtest, here is basically the backtest we're going to use. This is trading a put with no filter every single day at 325 every day. The first concept here with backtesting that I want to start with is we start with an edge. And the reason we start with an edge is because by having that, we can in turn make money over the long term, so as long as we manage our risk. And when I'm talking about edge, or what we could maybe call structural alpha, I like to go through edges that are very large. So for example, at this 325 slot, the limit down rule expires. I will link this in the article below, but here is the SEC website. And it basically says a market decline that triggers a level 1 or level 2 circuit breaker before 325 will halt the market trading for 15 minutes, while a similar decline at or after 325 p.m. will not halt the market trading. A market decline that triggers a level 3 circuit breaker at any time of the trading day will halt the market, therefore, for the remainder of the day. So this basically shows if the market goes down 7% after 325 or 13% after 325, it is basically not going to halt the market. So therefore, it makes sense there is additional edge in regards to that. The other thing I would like to point out in regards to edge is in the latter half of the day, brokers have margin requirements. So with those margin requirements, people have to close out their orders, and a lot of people don't want to carry that risk overnight into the following day. So there is an excess of basically people transacting and closing out their positions. Therefore, it would make sense that the market compensates us a little more at this time of day. And again, a lot of people ask me, why are you sharing this? This edge is so big, no matter how many people crowd into this, people are still going to close out their, margin requirements. Then they close out their orders, and the limit down rule makes sense why there's a little bit of additional edge. The next thing I would kind of like to regards to edge here is that dealers basically have to hedge at the end of day. And what that means is that at the end of day, dealers want to be delta neutral with zero directional exposure. So they are going to basically have a little more mean reversion in terms of price action of the SPX towards the end of day, because they have to go up 5 points, down 5 points, up 10 points, down 10 points, because options will either be 0 or 1 delta at expiration, or 0 or 100 delta, however you'd like to see it at expiration. So they're going to hedge a little more, and there'll be slightly more mean reversion. The reason we choose puts in regards to this is because puts are not necessarily just bullish when they're further out of the money. They're also, due to skew, there's an additional decay in regards to those. So even though we're selling a put, we're almost delta neutral because we're just playing decay towards this time of day. So when we're looking at this, I want to talk about the next facet for finding edge is basically that we have an accurate price and we can protect against risk. So in regards to this, how do we form an accurate price? It's predominantly going to be with our backtesting procedures. So first thing I'd like to show is that We've started out with why we think they're edge. We have academic articles that back that edge up, and it makes sense to us. Also here, accurate price, we're not filtering out any entries. There's no entry filter. So this is a full set of data for all that we have available since 2013. Also in regards to this, our stop loss is based on the national bid best offer. So this is encompassing of the worst possible case scenario. The other thing I like to do here to eliminate as many variables as possible is you can see here with the entry slippage, I put 10 cents. Obviously to enter a $1 order, that would be 5 cents at max. But what I want to do is I want to work in the cost of that wing or that 5 cents to cap our buying power. And basically by doing that, we in turn are able to eliminate shopping a two-legged order, which could give us a more inaccurate price. And also with the stop loss slippage, 2x stop, we'd be buying back this order for $3. So 5% of that is 15 cents. Therefore, this should be more than accurate, probably overstated on what is actually happening. And you see for every dollar we sell, we keep 11.6 cents of it. So that is all very great. The next thing that I would like to speak about in regards to this is how we protect against a risk. So obviously we're using a stop loss. That's not too fancy. But the other thing to note here is at this time of day, it's very cheap leverage. So if we're buying a 5 cent wing, which we worked in here, let's say maybe at max, we're 100 points wide. So with doing that, the whole circuit breaker rule that is down 7%, 13%, and 20% doesn't really affect us because if we're 100 wide, that's roughly a 1.5% move. So if the market did get gap down completely, the benefit of trading options and vertical spreads is I can guarantee you what our max loss is, which is not the case in many other assets. The other thing that I want to speak to in regards to this is what is the most optimal way to do it? You can see here that it may not look quite amazing here with this 11.6% capture and then 0.4% MAR. I do have it here back to just 2022 and SPX dailies. This would be the most probably accurate assumption we could make because it didn't filter out any days because you could see it trades every day of the week with 0DT now. And you can see, it's a quite better capture in MAR. So that could give you a little more confidence. The next thing I would like to speak about is people are like, oh, well, why don't we delta target? So if we look at delta targeting, you can see that the capture rate comes down. It may work a little bit better and higher in vol, but the concept here is that when we're taking risk, we want to take the same size risk every day. So when we're trading a 15 delta option in a high VIX, we could be collecting, significantly more. You'll see here 20 cents, 60 cents, not very high. If we go back in time to 2022 here, you could see that, we're collecting significantly more premium, $1.25, $1.40. So we're taking sometimes 2 or 3 times more risk at this time in 2021 and 2022 as comparative to now when volatility is very low. So when we lose, because we have that fixed win rate and our edge is not necessarily, massive here, we want to make sure we're losing the same every time and we're winning the same every time. Therefore, with the credit targeting of $1 comes in fact. Now, the next thing I would like to say is you could see here that 2017 really struggled, which was a very low volatility year. And we can see that this year dragged a little bit too. So would it make sense to filter out entries with different VIX parameters, basically? So now when we're looking at this, when we have a minimum VIX of 15, we have a 12.4% capture going back to 2013. And then when we have a maximum VIX of 15, we have a 10.4. With a 15 VIX here, we still have a 10% premium capture. Obviously makes sense to trade this. You can actually see that it did very good this year, even though it dragged in 2017. So again, with going back to the concept of creating mini occurrences and therefore not filtering out entries to have the best and most accurate price, it obviously makes sense we should do this. The next thing I would like to talk to is basically in regards to execution. So when we're speaking about execution, some concepts that I kind of want to go for is this basically performs best as synthetically naked. So that's buying that 5 cent wing. In regards to this, that is what we want to do. Therefore, it's cheap. Do not trade this naked. It's way too much risk. At the end of the day, the at the money price may be below or like $2 below your stop. So be very careful with in the money protection here. And the last 10 minutes, you really don't want to be carrying an in the money option. So if you have the way to exit on a delta touch in the last 10 minutes, I would recommend doing that. Also, in regards to this, entering at 325, again, put that wing in. I've looked at selling between 10 and 20 delta. It doesn't work that well. You should expect to collect between 60 and 110 cents. I always like to be a little bit further out of the money if I can. Also with the stop, we're always doing a 2x stop. Only on the short leg, we're considering that 5 cents basically a throwaway. Hence with that, a lot of people will also ask me, why don't we sell calls? In regards to calls, they look okay, but frankly, the backtests aren't really catching the trading that well. You could use discretion if you want. It's not my cup of tea. You could say that the call is free. It looks pretty bad. I want to, again, trade based on the structural alpha, which looks like that put skew and that decay. And then as we went over with the limit down rules, I'll share this with everyone as well as the articles. The biggest concept I kind of wanted to go over here is that we find the edge. We start with edge, AI, machine learning, data. That's a way to analyze edge. It can never create edge. You can't filter out stuff. And then I also want to just show how this is a good structural trade and an advantage of how you can use stuff. And it's a valuable part of the portfolio. Is this one trade that you're going to trade and you're going to get rich on? Probably not. But is this something that you could sell, 10 basis points a day in credit or 50 basis points a week in credit and basically make 5 basis points, a week on your portfolio? Yeah, it's really capital efficient. It's going to be, diversified. That's how I would run it. That's how I recommend doing it. If you guys have any questions or comments or kind of like more stuff like this, please let me know, and always appreciate you guys for tuning in and share it with anyone that you think will get benefit from. Thank you.